Welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Jeffrey Dennis, independent emerging markets commentator, joining in. Welcome to the show, Jeff, and always a pleasure to speak to you and get insights. Jeff, a lot's happening globally right now, not only across developed markets, but also in emerging markets, from central banks changing their stance, looking to tighten liquidity, increasing rates. Plus, inflation is becoming a worry as well across. How are you seeing the entire economic, outcome so far?
Well, I think you have to start in the US, and I think you have to start with the outlook for US inflation because that I think is going to determine the direction of bond yields from here. And that will also, I think, impact how much more Fed tightening there's got to be. And there's got to be a lot more, to be fair. Perhaps I should say that will determine when interest rates start to look as if they might peak in the US. Now, my sense is that, and let me just say this as well at the beginning, I think the risk of a recession in the short term over the next 12 months is quite small. I don't rule out a recession in the second half of 2023. But I think what's happening here is because the Fed is so far behind the curve and real interest rates are so negative that we're going to be in this rising short rate environment for a period of time. Now, my sense is that inflation probably peaked at 8.5% in March. Maybe it could tick a little bit above that, but that was at or close to the peak. And I think once it becomes clear that that is the peak, I think markets will get some reassurance from that. Although, as I've continuously said in recent weeks, inflation's only going to come down very slowly to probably 6.5% by the end of this year, and perhaps, if we're lucky, to 4% by the end of next year. And what that means is that the Fed's got a lot of work to do, as I say, and that rates are going to be up 50 basis points. Next meeting, probably the one after that, around 2.5% to 3% by year end, with a bit more in 2023. So, in principle, these are challenging conditions for equity markets, including emerging. But on the other hand, as your listeners and watchers will know, your viewers will know, bond yields have started to get into a little bit of a trading range. And I think what you really need to see for equities to go sharply lower from here, we need to be wrong on inflation, going much higher or going considerably higher than that 8.5% peak. And we need to see bond yields going sharply higher. Without that, I think equities will be volatile and it'll take time to recover. But I think the worst of the selling will be over. And of course, that will have ripple effects across all the equity markets around the world. You're on mute. You're on mute.
Yes, sorry. So, Jeff, overall, if you see, even in terms of where Bank of England goes, you have to see the European markets have closed lower. ECB has gone ahead and confirmed the rate hike plans and said that they will be ending the bond buying program. How big an impact are you expecting out of that?
I think that's the really difficult thing to call, because logically, as central banks go from quantitative easing to quantitative tightening and start to run off their balance sheets, especially if you're looking at a country like the UK or the US, where you've had these massive increases in the budget deficit, I think logically bond yields would go quite a bit higher, because that would be a supply demand thing, lots of supply coming on the market. But I tend to believe that if there is visibility that inflation is close to its peak now in the US, I think it's less clear that's the case in the UK, less clear that's the case in Europe. But if US is being, I guess, the biggest market in the world, if we're somewhere near the peak, I think that will act as some sort of offset. But frankly, we've never seen in history this sort of balance sheet runoff that we're about to get from the Fed, from the Bank of England, from the ECB, and quite what that increase in supply, what impact that will have, is hard to say. So The way I'm looking at it is I think bond yields are probably close to, or maybe not quite at their peak. But the big risk here is that I'm dead wrong, and the supply side of the bond market, i.e., increased supply, is so dramatic that it pushes yields to 4%, 4.5%, 5%, for example, on 10 years. And if that's the case, well, then we've got a lot more weakness still to come, I think, in emerging markets and probably in global equity markets generally.
Right. And if you see in terms of the China data point that's come in as well, clearly the May inflation has jumped again. The expectation was that, that's something which will start to taper off. Growth will start coming back, but that's going to have a major impact as well on emerging markets. How do you view that data?
Well, I think that the main story out of China now has got to be assumed, I think, to be the emergence gradually of the country from these very, very severe lockdowns. Now, of course, given the zero COVID policy, President Xi, we can't ignore the possibility there could be more lockdowns to come. But logically, I think the worst of the economic data should be over, should be through now. I don't expect inflation to run out of control in China. I really don't. And I think China is going to be one of the countries that, as they've done already to a certain extent, will be able eventually to start easing monetary policy a little bit more. So I think you will see the Chinese economy beginning to recover as you head into the second half of the year. Certainly not to a typical Chinese growth rate or anything like that. But if that were to happen, I think Chinese equities, which are already beginning to rally now, and I'm sure we'll talk about that, will get another lift from that, which of course will support emerging markets overall. But also, I suppose on the risk side for inflation worldwide, is it could push up commodity prices a bit further, particularly oil, of course. And that obviously would be a risk, although in the case of emerging markets, you've got a number of countries in the Middle East and in Latin America which benefit from higher oil prices. So it's a bit of a double-edged sword, but my assumption here is that the Chinese economy recovers from here probably relatively gently. Inflation doesn't run out of control, and that I think will be a net positive for financial markets around the world as we go over the next 12 months or so.
Right. So how are you viewing the emerging markets, and where would you place India currently?
Well, I wrote a post on LinkedIn not very long ago, a couple of weeks ago, where I pointed out to people that, if you forgive me going backwards a little bit on this, is that for a long time in the US, and I'll get around to emerging when I've gone through this, in the US, when bond yields rose, when bond yields rose, i.e. bonds fell, equities also fell. Latterly, you'd started to see concerns, I think, switching a little bit away from inflation towards recession fears. So when equities would fall, bond yields would actually decline. And the reason I'm saying all that is that when that started to happen, and this was about 6 weeks ago, I mean, it's reversed a little bit now because bond yields are back just above 3%. When that started to happen, the dollar started to come down. And the dollar looks like it's peaked for now against the euro, although it's obviously staying relatively strong. I made the point there that if that fear about recession was going to be the dominant theme as you go through the rest of the year, rather than the fear of inflation, and the dollar were to weaken a bit more, I would expect emerging markets to outperform developed markets over the rest of the year. And that is starting to happen, although we're down less than the developed markets as of last night by about 100 basis points, which is very good. I also made the point in that post that it's extremely unusual for EM to outperform DM in down markets. It's actually only happened 3 times in the last 30 years. And so this is an unusual environment. And this is, I think, because of the role of commodity prices helping emerging markets, because there's a genuine fear of recession in the US, which is could push the dollar lower from here. So I'm hopeful, actually, short of there being a big explosion upwards of inflation over the rest of the year, worldwide and in the US, I'm hopeful that EM will very erratically, very slowly, I'm sure, rally further and get away from this, low teens decline that we're in at the moment, possibly continue to outperform developed markets. China, for example, is down less than the US is down now this year, which is interesting. Now, India, one of the things that is benefiting EM in 2022, apart from the fact that you've got Latin America being big commodity exporters, the Middle East big commodity exporters, apart from the fact technology is less important generally across EM than it is in developed markets. But one other big advantage EM has had is a lot of countries raised rates last year. A lot of central banks raised rates as sort of early protection for the inflation increase that was coming. India did not do that. So in that respect, India's probably got a fair amount of work to do. I know the central bank has just raised interest rates by 50 basis points, and that's probably a very good move to 5.4%. And I think that there's probably more to come. Inflation's nearly 8%. So the central bank in India is a bit behind the curve, frankly, and I think that's going to be a drag on the market. So my own sense is that although the growth looks pretty good, frankly, one of the best, if not the best in EM, which will be helpful, my sense is that India is probably going to be an underperformer because you're going to be in a situation eventually, possibly, not many months in advance, where you're going to be able to see that certain other emerging market central banks will be able to stop tightening, whereas I think India's got a fair amount to go. So I would say it's a neutral to a small underweight, even though, of course, as ever with India, you've got a great growth story there. But the RBI's got a lot of work to do, I think it's fair to say.
Absolutely. And that's what everyone's watching out for as well. Thank you, Jeff, so much for joining us on the show. Always a pleasure to speak to you. Take care and wishes to your family as well. Hope to see you recover soon. Thank you so much.
Okay. Thank you. Bye-bye.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.